What is good, YouTube? It's your boy Only Trader, and I'm back with another video. And as you can see, after a lot of time of people requesting this, I finally found the time. I finally found the time to come onto the platform and provide you guys with some basic but still very important concepts, and we're gonna be going through those concepts today. So I did this series like maybe a few months ago, maybe about 6-7 months ago, and at that time I did it with my basic understanding of day trading. And after spending all of that time on the charts, I feel like it's only fair that I come to you guys and I begin to dissect it with more in-depth knowledge, due to the fact that I've been on the charts almost every day for like the past year. So I've seen a lot, and now I feel it's the perfect time for me to come with this video and, dive in on the concepts and also just refresh our brains. It's never a bad idea to refresh your brain. There are obviously concepts that you've forgotten unless you've been reading it every day, but due to that, it's always best to just come back, refresh our brains, do it again and again and again. So, with that being said, let's go straight into the content. Let's go straight into the content, and let's not waste any more time. So, we've got our introduction here, which the Candlestick Trading Bible is the most powerful trading system in history. Basically, the Candlestick Trading Bible is going to show you how candlesticks work and how candlestick patterns work as well. That's the main thing of this whole book, because it's going to show you that, because when you're on the charts, that's all you're going to be seeing is candlesticks. So it's best you learn how to identify the different patterns and the different candles and what they mean. So we'll go down, we'll skip that. So we'll go down. It's just an overview of what the book is going to provide, from the anatomy, basically how to read candles from the size of the body to the length of the wick, etc., etc. Then we go down to the candlestick patterns, which, if you've been watching my live trades, I'm sure you've seen the double bottom patterns, the double top patterns, the triple top patterns, the head and shoulder patterns. All those are patterns, and that's just when a lot of candles form a structure, I could say. A lot of candles form a structure, and we call that a pattern. Then the market structure. The market structure is basically just identifying the direction of the market. Are we trending up? Are we trending down? Are we ranging? Are we at a reversal? Have we broken past that uptrend and now gone into a downtrend? Have we gone from that downtrend to an uptrend? Have we gone from a downtrend to a range? You have to be able to always identify those things, so that you're always on the right side of the market and never trading against the market. And if you do find yourself trading against the market, good luck. And I would suggest take those little pips that you're going to get, because don't expect to get 30-40 pips just from experience, just my experience. So that's just my experience. But as they say, you have to try things out for yourself, and I tried it out for myself. I cried. That's why I'm here, so that you guys can also learn from my mistakes. So the multiple time frame analysis, that's basically going from your daily to your 4-hour to your 1-hour, down to smaller time frames, and how you're gonna use all the things that you see on each time frame to come up with a trade. And then the trading strategies and tactics, that's gonna be basically, if we're looking for engulfing, inside bar strategy, etc., break and retest, basics, but still the most important basics, because that's the foundation for your trading. So let's get straight into it. History of, we don't really need to know that. If you really want to, you can just download the PDF, leave a link in the description below, and you can thoroughly go through it yourself. But with that being said, we just want to go straight into it, and we start off with what is a candlestick. So this is the candlestick right here. This is what you'll be seeing on the charts, most likely in green and blue, in red and green form. Red is usually the bearish candle, green is usually the bullish candle. And as you can see from here, we have the candlestick body. We have the body, which is where price opens, price closes. That's the body. And then we have the wick, where you'll see the body move up and come back down and leave this line, which is a wick. And this wick basically indicates that price attempted to go up, but it didn't manage to close in that area and it came back down, or price went down and it didn't manage to completely go down. It came back up and it closed here, and it leaves a wick, basically a shadow showing that you were once there, even though you're not there. So if the close is above the open, we can say that the candlestick is bullish, which means the market is rising in a period of time. Bullish candlesticks are always displayed with white candlesticks. So it's either white or green. And bearish candles are usually red or black. So you can find different colors used between bullish and bearish candles. The filled part of the candle is the body. The thin lines poking above and below are the shadows or the wicks. The top of the upper shadow is the high. The bottom of the lower shadow is the low. So every candlestick has a different size. Some you're gonna see them like this, some you're gonna see them like this, and they all have different indications for what price is doing and how traders are behaving in the market at that time. So we really want to go into the concept of what exactly do these candles mean. So as you can see here, just from looking at this, you should be able to identify that this is a bearish candle, which means that price at some point did try to go up, didn't manage to stay there, and came back down, closed at this point, and closed in a bearish form. But what does this indicate? That there was some buying pressure, but not enough to go past, and it came back down. So that means that the sellers are dominating the market. This is just basically the opposite, where the candle is bullish, but clearly it indicates that there were sellers in the market at some point. They pushed the price all the way down here. At some point, this whole body was all the way down here. But then buyers came back into the market. They pushed it here. Didn't manage to go above its entry point, and it closed bullish. But this basically indicates that there are a lot of buyers in the market, and they managed to outmaneuver the sellers. So the long wick basically just shows you that whatever direction it was going in, people managed to come in and place enough orders for it to go back to where it actually was. So the Japanese candlestick with the short shadows indicate the most of the trading action was confined near the open and close. If a candlestick has a longer upper shadow and short lower shadow, this means that buyers flex their muscles and bid price higher. But for one reason or another, sellers came in and drove price back down to the end of the session, back near its open price. If a candlestick has a longer shadow and a shorter upper shadow, this means that the sellers flashed their washboard abs and forced price lower, or flashed their titties for all the ladies. But for one reason or another, buyer came in and drove price back up to the end of the session, back near its open price. So next, the candlestick patterns, which are the most powerful trading concepts, because once you can identify a pattern, you can almost identify where to get your entry point and which direction it's going in, and it saves you from being faked out, because you've clearly seen that price tried to push up, came back down, formed a double bottom pattern, meaning that it was not able to close below that support. If it's not able to close below that support, that means it's going to reject it, and buyers are going to come in, flood the market with buying orders, and price will go up to the resistance. Once it gets to that resistance, we're going to see where the price is going to push through that resistance or come back down. And most of the times you're going to see a pattern forming, because price will try to push through that resistance, maybe fail, come back a bit, retrace, try to push through it again. If it pushes through, that's what we call a break and retest. If it does not push through, that's when we now call it a double top. So basically, that if you can identify trading patterns, that's gonna be a game changer for you, because from that you can tell that price is failing to get past a certain point, is being exhausted. So basically you can anticipate that direction that the market is going to move in because of the pattern. So patterns are the language of the market. Imagine you're living in a foreign country and you don't speak the language. How could you live if you can't even speak a word? It's tough, right? The same thing when it comes to trading. So you have to know your patterns, because once you can identify patterns, you can identify the best entry points. So this skill is going to help you better enter and exit the market in the right time. In other words, it'll help you act differently in the market and make money following the smart guy's footprints. Because if not, the alternative is to see a bullish candle at a support and just take the trade. Maybe get faked out. Maybe the candlestick doesn't even move. Maybe there's no volume. But at least with the patterns, it's going to show you the genuine direction of where that trade most likely will go. And it's going to show you if there's volume. Because for that pattern to form, there has to be some sort of volume in the market. Otherwise, it's going to continue ranging. So what I want you to do is to focus on the anatomy of the pattern, the psychology behind its formation, and to focus on identifying the pattern. So we're going to start with the engulfing candlestick pattern, which is probably the first pattern, as you can see on the book, but it's the first pattern that most traders are going to learn because it's one of the most simple concepts, where it's just a bearish candle completely, as you can see, a bearish candle completely engulfing this bullish candle, completely overpowering it. So what does this indicate? Just from a common sense perspective, it's going to indicate that there are a lot of sellers in the market, because they managed to completely engulf this candle 2 times over, maybe even 3 times over, which is going to indicate that there's a lot of sellers in the market, and that's what you'd call a bearish engulfing bar. So this is how it's going to look like when you're looking at the charts, which is why it's very important, guys, that you can't just listen to these concepts. You have to actually go out and put them to practice. If you have another monitor or display with you, or on your phone, go right now, open up TradingView. As I'm saying this, look at the patterns, try to identify it, because the more you look at it, your subconscious is always going to pick it up. So as you can see, that's a bearish engulfing, and you can clearly see that at this point price was trending up, and then came this, I would say, doji candle, which this already is a candle that could be identified as a reversal, because clearly you can see there's a lot of bullish momentum, and all of a sudden all of that is exhausted at this resistance. Would say this is a resistance, so all of that has been exhausted at this resistance, which means that at this resistance there are most likely a lot of sellers, maybe sell limits, etc. People who, maybe they set trades earlier on, and then they're just waiting for price to get to that point, and the platform is automatically going to put them in, and then that becomes the reversal, and clearly it shows us a bearish engulfing pattern, because it's engulfed this maybe like 10 times over, which means that the sellers came in at this point 10 times over the buyers, and that's what caused price to finally to start going back in the other direction where it came from. So it's going in an uptrend. You see the doji, you see the bearish engulfing pattern, and next thing you see, price is now trending downwards, because this is an indication for a reversal. So as you can see, when this pattern occurs in an uptrend, we can anticipate the trend reversals. You can trade any bearish candlestick pattern you find on your chart. You'll need other technical tools to confirm your entries, but as long as you can identify the patterns, that's the first point where you can begin to make profitable trades, because now all your trades are not random. At least you have that one thing that if I see this, I have a good chance that price is going to go in this direction. Even if you don't know anything else about trading, just from seeing that pattern, you at least now know. If this pattern happens, there's most likely going to be a reversal, and you'll take that into mind every single time that you execute a trade. So we'll talk about this in details in the next chapter, but right now I want you to open it, which I told you guys, open up your charts, look at the charts, look at the candlesticks, identify it. Even if you're not understanding it, I promise you, if you consistently do it every day, your subconscious will catch it. And all of a sudden, you see one day it just makes sense. So the bullish engulfing bar pattern is basically the opposite, where we have a bearish doji candle and a large bullish candle, and clearly you can see that price opened here and closed above here and completely engulfed it, completely ate it up, and clearly this shows that there's a lot of buyers in the market. So when you see it on the charts, it looks something like this, where maybe price was trending down, and then right at the bottom where a support is created, the pattern is also formed. So you can see now we have a support here and we have the candle pattern forming, and because it's a bullish engulfing pattern, it leads to a reversal where price was trending down, all of a sudden it's now going the opposite direction, going up, because this clearly indicates that the bulls managed to overtake the bears. So the example above shows us how market direction changes after the formulation of a bullish engulfing pattern. The smaller body that represents the selling power is covered by the second body that represents the buying power. The color of the body is not important. What's important is that the smaller one is totally engulfed by the candlestick. So yeah, the color of the body doesn't really matter. The color of the body is just going to identify whether we are bearish or bullish. But the main concept is to see that the larger candle is engulfing the smaller candle, meaning that the larger candle is most likely going to push volume up in this direction, as opposed to the smaller candle continuing to push volume in the direction that it was going in. And that's what we'll call a reversal. So now we have the Doji candlestick pattern, and it's one of the most important candlestick patterns because it's a candlestick pattern that you're going to see often many times, especially when price is trending. And the Doji candlestick basically shows indecision in the market. And as you can see with the way that this candle has formed, you can't really tell, are there buyers, are there sellers, and that's what usually happens. It means that within that candle, price is ranging. It means that there are a lot of buyers, there are a lot of sellers, or there are too few buyers and there are too few sellers that they can't constantly pull on the tug of war. They're just at a standstill. They're in a cold war, to be exact. And that basically means that with that candle, you're not really sure which direction it's going to move. It might indicate a reversal, but at the same time, it's not a guarantee because of what it indicates from the fact that buyers and sellers are at a standstill. So it could be a reversal if we're trading up, but it could also mean that price is just going to continue going in that direction. So that's why it's always best to identify it. But at least when you can see it forming in an uptrend, you can see that maybe there are not enough buyers to push price past this zone. So there's a chance that sellers are going to come in, and vice versa for a downtrend. So as you can see on the chart here, we were in an uptrend. The Doji candle came, very strong bullish momentum. Next thing, there's a Doji candle. What's this? Indecision. And what does indecision lead to? It leads to a reversal. But it's not that it's going to reverse every single time. It could pull up this pattern and then continue moving up. It's 50-50 at this point. But when you have all the other trading tools in your arsenal for you to muster up a trading strategy, a trading plan, and for you to execute that trade, this will be one of those small details that you can scale into and use to become more profitable. The chart above shows how the market changed direction after the formation of the doji, and as you can see, the market was trending up. The doji came, the market began to trend down. So remember always that a doji indicates equality and indecision in the market. You'll often find it. I just need to make sure you guys, it indicates, because you guys just saw it right here in this trend, it doesn't mean that it's always going to go down. It indicates equality and indecision So you'll often find it during periods of rest or after big moves higher or lower. When it's found at the bottom of the top of the trend, it is considered a sign that a prior trend is losing its strength. And usually on the markets, when you see prices finally starting to exhaust after an uptrend, you'll see as you get closer to the top of that trend, you'll see a lot of doji candles, a lot of indecision candles, very, very small ones, starting to accumulate, and that most likely means that that move has been exhausted and the trend is over. It might begin to range or it might reverse. So if you're already riding that trend, it's time to take profit and get out the trade. Take your profits, don't be greedy, which that happens to me, man. But learning process, and as long as we don't quit, we gonna get better. So now you got the Dragonfly Doji, and the Dragonfly Doji, similar to the Doji candle, as you can see, but instead of it being of price closing in between, we see price closing at the top. And this is formed when the open high and close above are the same or about the same, and the close are the same or about the same price. What characterizes the Dragonfly Doji is the long lower tail that shows the resistance of buyers and the attempt to push the market up. So as you can see, we have price opening and closing at this point, but this clearly indicates that there were some sellers. They managed to sell it down to this point, but the price didn't manage to close, and buyers came back up and it closed here. So that's a perfect doji. The long lower tail suggests that the forces of supply and demand are nearing a balance, and that the direction of the trend may be nearing a major turning point. So as you can see right here on the chart, we have a downtrend where price was trading down from this point to this point, and then we have the Dragonfly Bearish Doji that forms here. And as you can see, it means that price went down, sellers came in, buyers came in at this point, they pushed it back up, and it still managed to close bearish. But then just from this long wick, it's an indication that it came down and it went up, meaning that at that point in time, there are a lot of buyers in the market. And the chart above, the market was testing previous support level that caused a strong rejection from this area. The formation of the Dragonfly Doji with the long lower tail shows us that there's a high buying pressure in the area. If you can identify this candlestick pattern on your chart, it'll help you visualize. It'll help you visually see when support and demand are located. When it occurs in a downtrend, it is interpreted as a bullish reversal signal. But as I always say, you can trade candlestick pattern alone. You'll need another. You can't trade candlestick patterns alone. You're gonna need another indicator and tool to determine high probability. And that indicator or tool to determine high probability is called price action, where you identify structure, you identify behavior, you identify patterns. If you want to use your EMAs, etc., that's up to you. But for me personally, I do not use that. And with that being said, that's another video, gang. I hope you guys really enjoyed the content. We'll pick this up later on and go through this, identify it. I had to do it again because I told you I'm not the same trader I was back then. So I can look at these contents more in depth, more in detail, and with experience on the charts, and say this is how this certain pattern usually operates on this pair, etc. And if you guys watch the live streams, keep tuning in. I'll be back next week. More live streams to come for all of you. Better trading, more improvement. We're just gonna lock in from now on up until we get to our goals. Not even up until we get to our goals. We're just gonna lock in for life, because at this point it's not even a goal, it's a lifestyle.